Imagine a company that is, actively dethroning a 50-year-old tech monopoly.
Right, which is wild to even think about.
Yeah, and they're operating in a market that like literally just doubled in size to a staggering $120 billion virtually overnight.
And I mean, pulling in profit margins that seem to completely defy the physical laws of manufacturing.
Exactly. They're essentially building the physical toll booths for the future of artificial intelligence.
Yeah.
Now, imagine Wall Street looking at all of that unquestionable dominance and just saying,
We're neutral.
yeah, we're neutral. It's so weird.
It really is. I mean, it completely breaks your brain when you first look at it. You expect financial analysis to give you a clear, logical verdict, right? Especially when the underlying data is this extreme.
Right.
But this is where the tension in, modern tech valuations actually lives.
And that paradox is exactly what we are decoding today in this deep dive. So we're looking at a May 6th, 2026 financial research report from JP Morgan covering advanced micro devices. AMD.
A massively important player right now.
Yeah. Oh, absolutely. And the friction inside this specific report is just fascinating. Because on one hand, JP Morgan drastically raised their price target for AMD from $270 all the way up to $395.
Which is a huge jump.
Right. But simultaneously, they maintained a cautious neutral rating on the stock itself.
Yeah, which feels like a contradiction.
Totally. To hike a target that aggressively, but tell investors to essentially, stay on the sidelines, something complex is happening under the hood.
For sure.
So we need to figure out what this tension tells us about the broader AI landscape that you, the listener, are navigating every single day.
Okay, let's unpack this. Let's start with the sheer scale of the quarter AMD just reported, because JP Morgan categorizes this as a clean beat and raise.
Right. And just to clarify that for a second, a clean beat and raise means they didn't just beat the financial expectations for the quarter that just ended. They also raised their own internal guidance for the upcoming quarter.
Yeah, and they did it without relying on, weird accounting tricks or one-off tax benefits. The underlying business is simply generating more cash than anyone modeled.
Okay, and to put some scale to that, first quarter revenue hit $10.25 billion, beating the $9.89 billion consensus. And earnings per share were at $1.37, which is up 43% year over year.
Yeah, massive growth.
It is. But I actually don't want to get bogged down in the backward-looking decimal points here, because the real shockwave in this report is their forecast for the future. I mean, management just doubled their server CPU total addressable market projection.
Yes, the TAM. In business terms, the total addressable market is the absolute ceiling of how much money exists to be captured in a specific space.
Right, the whole pie.
Exactly. And back in November, AMD was projecting the server processor market would be worth about $60 billion by 2030. Just a few months later, they are now telling Wall Street that number will be over $120 billion.
Wait, really? Just a few months later?
Yeah. Furthermore, they raised the expected compound annual growth rate, so the speed at which this market is expanding year over year, from a respectable 18% to over 35%.
Wait. You don't just revise a multi-year industry forecast by $60 billion on a whim.
No, you definitely don't.
That suggests the entire foundation of the internet's infrastructure is expanding, like twice as fast as anyone thought just half a year ago. Why? What triggered that kind of violent revision?
What's fascinating here is that the report points to a very specific phenomenon. They call it the agentic inflection.
The agentic inflection.
Yeah. So up until very recently, the artificial intelligence we've all been using has been entirely passive. Think of it like a brilliantly smart reference book, right? You type a prompt into a chatbot, the massive data centers process that specific request, generate your answer, and then the system essentially goes back to sleep.
Right. So the compute power is only spun up for that single transaction.
Exactly.
So it's a one-on-one exchange. I ask a question, it uses energy to give me an answer, transaction complete. But an AI agent completely changes that dynamic. We're talking about moving from a passive chatbot to an autonomous digital worker, one that operates in the background 24/7.
That's the key difference.
Right, because you don't ask it a question, you give it a broad objective. You say, manage my entire email inbox, draft replies based on my past communication style, and book meetings on my calendar.
Precisely. And to execute that, the AI agent has to continuously monitor data streams. It has to break your large goal into a dozen smaller subtasks, execute them sequentially, verify its own work, and correct errors in real time.
Wow.
All without you ever prompting it again.
Which means the underlying physical servers never get to go back to sleep.
Right, they can't.
The compute engine has to run constantly. And that makes total sense when you look at how this impacts the hardware layer. If millions of people and thousands of massive corporations are deploying these autonomous background agents over the next few years, the physical infrastructure required to support that continuous loop of processing is going to break the current supply chain.
And that is exactly what AMD's biggest clients are realizing. JP Morgan notes that this $120 billion TAM expansion is directly supported by accelerating demand signals from hyperscalers.
So the really big guys.
Yeah, we are talking about the massive cloud providers you rely on, the companies hosting your company's data, running your streaming services, powering the enterprise software you use at work.
Right.
These hyperscalers are realizing their long-term physical capacity needs for this agentic transition are astronomically higher than they initially budgeted for.
Okay, so if the market is suddenly twice as big, the obvious question becomes, who is actually capable of manufacturing enough silicon to fill that gap?
Right, because someone has to build it.
Exactly, because this expanding pie isn't being shared equally.
Yeah.
AMD isn't just floating upward on a rising tide. They're actively bulldozing their competitors' foundations to grab more land.
Yeah, the momentum is severe. I mean, the report highlights that AMD just posted its fourth consecutive quarter of record server CPU revenue, growing over 50% year over year.
50%, that's insane.
It is. That kind of sustained acceleration is incredibly rare for a hardware manufacturer operating at a multi-billion-dollar scale.
And the report attributes a lot of this to the ramp up of their Turin chips. They gained 300 basis points of market share.
Yep.
Just to translate the finance jargon for a second, that means a full 3% of the entire global market for server processors shifted away from competitors and over to AMD in just a few months.
Which is a massive swing.
It really is. That brought them to about 44% total market share. But this is the detail that absolutely floored me. We all know the historical narrative in tech, right? Intel is Goliath.
For 50 years, basically.
Yeah, for 50 years, Intel has essentially owned the data center market. But JP Morgan's model is now projecting that AMD's server CPU revenues will actually exceed Intel's by the fourth quarter of 2026.
It is a massive structural shift in the industry. I mean, data centers are incredibly conservative environments.
What do you mean by that?
Well, you do not rip out legacy Intel server racks and replace them with a competitor's architecture unless the performance and power efficiency gains are so overwhelming that you are, like, mathematically forced to switch.
Oh, I see. It's too expensive and risky to just try something new for fun.
Exactly. AMD's multi-year engineering strategy has culminated in chips that are fundamentally outperforming the legacy architecture, and their new long-term target is to capture over 50% of the entire market.
Wow, over half.
Yeah, which the report explicitly notes involves taking share from both Intel and the newer ARM-based competitors.
Okay, I have to stop you here and push back on the core premise.
Yeah.
You were telling me AMD is dethroning a 50-year monopoly.
Yes.
They are seizing dominance in a market that just structurally doubled to $120 billion because of a fundamental shift in how AI operates.
Right.
By every metric you've laid out, this company is executing flawlessly. So what does this all mean? If AMD is literally taking the crown from Intel, why isn't JP Morgan screaming from the rooftops that this is an absolute buy?
Because CPUs, the central processing units we've been discussing, they are only the entry ticket to the modern data center.
The entry ticket.
Yeah. Think of them as the general contractors. But to actually train and run these massive autonomous AI agents, you don't need general contractors. You need an army of highly specialized laborers. You need AI accelerators, specifically GPUs.
Ah, right. The graphics processing units. The specialized silicon that does all the heavy lifting for machine learning.
Exactly. And this is where the real execution risk lies. Because AMD is in a fierce, hyper-competitive race here against absolute titans, namely NVIDIA.
Right. NVIDIA is the elephant in the room.
For sure. So AMD's data center revenue overall was $5.775 billion, which is robust. But Wall Street's eyes are entirely focused on their new Helios and MI450 accelerators.
Okay.
The report notes these new AI chips are sampling with customers now, and they're actually exceeding initial 2027 forecasts, with JP Morgan seeing a sharp ramp up in production expected by fourth quarter.
That's coming up fast.
It is. They even project AMD is on a path to beat its previously framed 80% plus data center AI growth rate.
Growing an entirely new, incredibly complex hardware segment at over 80% is wild. But what really doesn't make sense to me is the profitability math JP Morgan lays out.
The gross margins.
Yes, the gross margins, which is essentially how much profit they keep after the direct costs of making the product. They were a positive surprise. They hit 55.4% and are actually guided to go up to 56% for the upcoming quarter.
Which is huge.
But hold on. Building cutting-edge silicon isn't like infinitely copying software code, right? It requires staggering upfront capital, highly specialized fabrication plants, incredibly expensive materials. How are they ramping up massive physical production of a brand new MI450 chip, and yet their profit margins are actually expanding?
If we connect this to the bigger picture, that is the margin magic of the current AI boom. It demonstrates unparalleled pricing power. But it's even more impressive when you factor in a specific accounting drag the report details, which is known as contra revenue.
Right, I saw that term. What exactly is a contra revenue mechanic in this context?
So think of it like a massive real estate developer offering an anchor tenant a sweetheart deal to move into a new shopping mall.
Okay, to draw in other stores.
Exactly. In this case, AMD likely issued stock warrants or significant financial incentives to absolute giants like Meta and OpenAI, just to secure them as the foundational customers for these new MI450 accelerators.
Wait, so AMD is effectively paying or heavily subsidizing their biggest customers to use their newest chips?
In the short term, yes. Those financial incentives act as deduction from AMD's gross revenue, hence the term contra revenue.
Right.
But strategically, it is brilliant. If you can get OpenAI to optimize their entire software stack to run on your specific hardware architecture, you create a massive competitive moat. You force the rest of the industry to follow suit.
Because everyone wants to be compatible with whatever OpenAI is doing.
Precisely. However, in the immediate term, those kickbacks put massive downward pressure on your profit margins.
So, the fact that AMD is absorbing the multi-billion-dollar costs of physically manufacturing these new chips while simultaneously taking a revenue hit to subsidize Meta and OpenAI, and they are still expanding their overall gross margins to 56%, that means they are charging an absolute premium for these chips.
Oh, absolutely.
The hyperscalers are so desperate for compute power that AMD can basically dictate the price.
Precisely. Silicon is the new oil, and right now, AMD owns one of the very few refineries capable of producing the highest grade.
All right, I see the dominant narrative now. The data center business is a high-speed rail network expanding at a blistering pace. Their pricing power is virtually absolute, and they are taking Intel's lunch money.
Yep.
But I'm still waiting for the massive downside that justifies this neutral rating. Where is the structural flaw?
The flaw is sitting right in front of you. It's on your desk, and it's in your living room. You really have to look at the consumer side of the business.
The client and gaming divisions. The chips that power our laptops and video game consoles.
Exactly. We've been talking about massive enterprise cloud providers buying AI infrastructure like there's no tomorrow. But every day, consumers are living in a completely different economic reality.
For sure.
JP Morgan highlights a severe drag coming in the second half of 2026 for AMD's consumer segments. A major factor here is memory cost inflation.
Meaning the physical components required to build a consumer PC are getting much more expensive.
Right, and when the internal components cost more, the final price of the laptop or the gaming console goes up, and everyday consumers simply delay upgrading. They decide their current machine is, good enough for another year.
Makes sense.
The report projects that AMD's gaming revenue is guided to plummet by more than 20% in the second half of the year compared to the first half.
More than 20%
A 20% drop in a core division is a heavy anchor. And overall, client growth meeting standard PC processors is being heavily tempered.
So you have this massive internal contradiction. The enterprise AI infrastructure division is experiencing a historic boom, while the consumer electronics division is facing a very real recession.
And that dichotomy forces Wall Street to look incredibly closely at the valuation of the stock itself. You have to remember, financial markets don't price a company based on what they achieved yesterday.
Right.
They price them based on the cash they will generate tomorrow and how much risk is involved in getting there. JP Morgan breaks down the exact math of their $385 price target. It assumes the stock trades at a roughly 35 times price to earnings multiple, applied to about $11 of earnings power exiting 2026.
Okay, let's translate that 35 times PE multiple, because that is where this whole puzzle snaps together.
Mhm.
A 35 multiple means investors are willing to pay $35 today for every $1 of profit AMD might generate in the future.
Yes.
That is an incredibly high premium. You only pay that kind of premium if you are absolutely certain those profits are going to grow aggressively without any hiccups. And JP Morgan uses a very specific revealing phrase in their analysis. Here's where it gets really interesting. They say the shares now reflect much of the multi-year inflection.
Which is basically analysts speak for. Perfection is already priced into this stock.
So they are essentially saying that at this valuation, Wall Street assumes every single thing AMD is planning will go flawlessly. The market is giving them zero margin for error.
Exactly. And in the advanced semiconductor hardware business, maintaining perfection over a multi-year timeline is nearly impossible. The physical reality of what they're trying to build is too complex.
Things break, delays happen.
Exactly. JP Morgan outlines several massive hurdles that present real execution risk, which is why they refuse to give it a buy rating.
What kind of hurdles are we talking about? Where's the friction point?
This raises an important question about their execution risk on their first rack scale ramp at the hyperscale level.
Rack scale, meaning they aren't just selling individual chips anymore.
Right. It's one thing to design a brilliant microscopic chip in a lab. It is an entirely different physical, plumbing, and engineering nightmare to deliver fully integrated racks to a client like Google or Microsoft.
Oh, like whole server units.
Yeah, we are talking about massive metal cabinets containing thousands of these MI450 chips working in perfect tandem. The thermal dynamics alone are staggering. These racks require advanced liquid cooling systems just to keep the silicon from literally melting itself.
Because these AI agents we talked about earlier are drawing so much continuous power, the heat generation is off the charts.
Exactly. AMD has to prove they can manufacture, assemble, and deliver these liquid-cooled multi-million-dollar server racks at a global scale without a single supply chain hiccup or thermal engineering flaw.
No pressure.
Right. If one cooling valve fails on a major deployment, or if there's a slight delay in the manufacturing yield, that 35 times valuation multiple will collapse instantly.
That makes total sense. They are priced as if they've already successfully deployed these racks, but the physical engineering required to actually do it is fraught with risk. What else is weighing on the rating?
Well, we have to remember those OpenAI and Meta warrants we discussed, the contra revenue.
Oh, right, the sweetheart deals.
Yeah, those financial incentives haven't fully cycled through AMD's financial models yet. They will continue to act as a headwind against total revenue for several more quarters. And finally, AMD isn't operating in a vacuum. To keep pace with market leaders in the GPU space, AMD must pour staggering amounts of cash into research and development.
R&D is never cheap.
No, it's not. The report notes their operating expenses are guided to step up 5 to 6% quarter over quarter straight through the second half of 2026.
Because building the track for this high-speed rail network is incredibly expensive. You have to spend billions of dollars today just to ensure you have a chip that can compete 3 years from now.
Exactly. So a neutral rating from JP Morgan doesn't mean AMD is a struggling company. The report clearly defines them as a dominant executing powerhouse.
Right.
But as a financial investment at this specific premium valuation, the risk to reward ratio is balanced on a knife's edge.
It really is a profound duality. You look at one side of the ledger, and you see the unstoppable force of the agentic inflection. You see a company actively ripping market share away from a 50-year legacy monopoly, expanding their profit margins despite massive capital costs, and building the literal engines that will power the next decade of software.
Which looks like an unquestionable victory.
It does, but then you look at the other side. You see a consumer hardware market that is actively contracting, pulling down the bottom line. You see an R&D arms race that demands billions of dollars just to stay relevant. And most importantly, you see a stock price that demands absolute perfection from a physical supply chain that is inherently prone to friction and delays.
It's a delicate balance, for sure.
Which leaves us with a really fascinating strategic question to think about as this all plays out. We're sitting here looking at a forecast that says AI agents are going to double the size of the server hardware market to $120 billion by 2030.
Massive growth.
But physical reality has hard limits. How long until the sheer cost of R&D, the massive electricity requirements, and the literal thermal limits of liquid-cooled data centers force a structural bottleneck on this entire industry?
It's the ultimate friction point.
Right.
We are watching massive software companies desperately trying to secure enough physical compute power to build these autonomous AI systems. But at what point does the leverage entirely flip?
Right. Will the hardware manufacturers who actually understand the physical thermal limits of silicon ultimately hold more leverage and pricing power than the software giants who are entirely dependent on them to survive?
It's definitely something to watch.
It's something to think about the next time an AI assistant seamlessly organizes your inbox or books a flight for you in the background. Somewhere in a massive liquid-cooled data center, a physical chip had to draw power and generate heat to make that happen. And right now, the companies forging those chips are priced as if they hold the keys to the entire global economy. Because honestly, they just might.
Yeah, they really might. Well, that wraps up our analysis for today. Make sure to subscribe to the channel because our next deep dive is going to be even more exciting.
Definitely. And as a quick reminder, this deep dive is for research and analysis purposes only and does not constitute any investment advice. See you next time.